Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Li Auto.
If you find our talks useful, please consider subscribe, like, and comment underneath. There is just an absolute elephant in the room today, and we really need to address it immediately.
Yeah, it's impossible to ignore.
Right. We are looking at a company that is currently down, over 60% from its 52-week high. We're talking about a stock trading at deeply discounted levels, sitting right around 11.735 cents.
A massive drop.
It is. And the headline that is causing everyone to, hit the panic button, June 2026 deliveries just fell nearly 15%. So our mission today for you listening is to figure out if this extreme pessimism is a classic value trap, where a cheap stock just keeps getting cheaper, or if we are looking at a massive generational contrarian opportunity.
And before we get into today's stock, we want to mention a tool that can help you map out these kinds of market moves. It's called VIP Algos. It's a TradingView indicator suite that gives you visual buy and sell alerts, trend direction, support and resistance zones, and TPSL planning. The link is below in the description. Just keep in mind, it is an educational tool only. It's not financial advice, it does not guarantee profits, and trading always involves risk, so do your own research. Also, that is an affiliate link, which means we may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context.
Right, because context dictates everything in this kind of scenario.
Exactly. So we've established that the stock is bleeding heavily right now. Why should a long-term investor, someone who is carefully trying to build a sustainable portfolio for themselves, even care about a seemingly collapsing asset?
It looks bad on the surface, I'll give you that.
Yeah, I have to push back a bit on the whole premise here. Are we just trying to catch a falling knife? Because catching a falling knife usually just leaves you with a bloody hand. What type of investor should actually be looking at this?
That is exactly the right lens to view this through, honestly. What you are looking at is a textbook turnaround and contrarian profile. Li Auto is currently navigating a really aggressive product transition cycle.
A product transition, so phasing out the old cars.
Exactly. They're systematically retiring their older legacy models and ramping up an entirely new fleet. And what that means for a wealth-building timeline is that fiscal years 2025 and 2026 are likely the bottoming years.
Meaning things get worse before they get better.
Right. They represent the trough of this transition. The potential recovery story, the actual payoff for investors, is slated for 2027. So to answer your question, this is absolutely not for the faint of heart.
It's a high-risk play. It's very high risk. It is specifically for patient investors who are willing to look past the short-term month-to-month price volatility and, connect the stock to the massive multi-year electric vehicle adoption trend. If you need immediate stable returns to pay a mortgage next month, this isn't it.
Makes sense.
But if you have a multi-year horizon, that's where you can start looking at this less like a falling knife and more like buying a coiled spring.
I see. So it's essentially about enduring the construction phase of a business model. It's like choosing to live in a house while it's being heavily renovated. You have to deal with the dust, the noise.
With the missing roof, yeah.
Right, with the expectation that you'll have a mansion at the end of it. But, and this is a big deal, but if we want to know if the company will even survive the renovation until this supposed 2027 recovery, we have to look under the hood.
That gives us the bigger picture. Now let's look at the fundamentals.
Because the fundamentals are flashing some serious warning signs. The June 2026 delivery numbers just hit, and they fell 14.8%. That is 30,895 units delivered.
Which naturally spooked the market. Absolutely. And in the first quarter of 2026, they actually posted an earnings loss, not a revenue dip, an actual loss driven by heavy discounting and just, aggressive cash burn. When I see an aggressive cash burn paired with a Q1 loss, my alarm bells start ringing very loudly.
Sure, and they should.
How does management plan to actually fix these margins without completely destroying their balance sheet in the process?
It definitely looks scary on the surface, which is exactly why the stock is down 60%. But we have to understand the underlying mechanics of what is happening on the factory floor. That 14.8% drop in June, that is not a spontaneous loss of consumer interest. That drop is directly due to those outgoing model runoffs we just talked about. They are intentionally phasing out older vehicles, which often requires heavy discounting to clear out the inventory, hence the Q1 loss.
Okay, clearing the lot, essentially.
Right. But if you zoom out just a little bit and look at the broader trend, their year-to-date deliveries are actually up 29.6%.
Wait, hold on. Let me stop you there. If their year-to-date deliveries are up almost 30%, which means they've delivered, over 1.73 million vehicles this year.
Exactly. over 1.73 million.
Why is the market completely ignoring that and punishing them so severely for a 15% drop in a single month? I mean, is Wall Street just suffering from extreme recency bias, or is that 15% drop revealing a deeper structural flaw that we're missing?
Honestly, it is largely recency bias combined with a deep fear of the unknown. The market hates uncertainty. Wall Street sees the transition and they panic because they don't know for sure if the new models will sell as well as the old ones.
So it's a prove it kind of market.
Exactly.
Right.
But in terms of fixing the margins, management's forward guidance is entirely tethered to their refreshed L-Series vehicles. These new models command higher average selling prices, or ASPs.
Ah, so they sell for more money.
Right. By selling a more premium vehicle, they inherently expand their profit margins. That is exactly how they plan to restore profitability once the factory ramp-up is fully complete.
Okay, so it isn't a demand cliff. It is a calculated product gap. But, a great car on paper doesn't automatically mean a dominant market position. The Chinese EV market is incredibly cutthroat right now.
Oh, it's brutal.
How are they actually positioning themselves against that fierce competition?
Well, they are operating in a highly competitive arena, but they have built a massive, highly specific competitive moat. Like Auto absolutely dominates the premium family-sized SUV and MPV market in China. And the way they do this is fascinating. They use this brilliant mobile home branding strategy.
Wait, a mobile home? Like an RV?
No, not an RV.
Hmm.
But they treat the interior of the SUV as an extension of the family living space. I mean, you have to understand the consumer psychology and demographics in China right now.
Oh, break that down for me.
You have multi-generational families, grandparents, parents, and children often traveling together in one vehicle.
Hmm.
You also have high-density urban living where physical space is at an absolute premium.
Right, space is luxury.
Exactly. So Li Auto designs these vehicles with built-in refrigerators, massive entertainment screens, and seats that fold completely flat into beds. They aren't just selling a mode of transportation.
They're selling a room.
They are selling a luxurious private living space on wheels. And the strategy is working perfectly. The Li i6, for example, ranked first in the full-size SUV segment for 4 consecutive months.
That makes a lot of sense. If you live in a cramped apartment in Beijing, having a spacious, quiet, climate-controlled room on wheels, that's a massive luxury.
Huge luxury.
But building that level of luxury and transitioning to new models takes an unbelievable amount of capital. What does their financial health actually look like right now?
That is where the margin of safety comes in. They boast a very rich balance sheet, maintaining a 6 out of 10 financial health rating. That cash reserve is the shock absorber for the cash burn you mentioned earlier.
Okay, so they have a cushion.
A very big cushion. And they are just setting that money on fire. They are aggressively reinvesting it into their own infrastructure. They have already built 4,097 supercharging stations, which encompasses over 22,000 individual charging stalls.
Which is critical, right? Because range anxiety is still the #1 hurdle for EV adoption, especially for families taking those long road trips you mentioned. If you control the charging network, you control the customer experience.
Exactly. They are building an entire ecosystem which locks the consumer in.
That gives us the business picture. Now let's move to the catalyst timeline.
Because timing is everything with a transition like this.
Right. Their survival hinges on these new L-Series models fixing the margins and their infrastructure keeping customers loyal. But a great plan on paper doesn't pay the bills today. When do these new vehicles actually hit the balance sheet?
Good question.
And more importantly, is the market already pricing in these launches? Because I want to warn you listening against fake timing confidence. Just because a car launches on a Tuesday doesn't mean the stock is going to rocket on a Wednesday.
You are absolutely right to be cautious, and that is a crucial distinction to make for anyone looking at this timeline. The physical launch dates are set in stone.
Okay, what are they?
The all-new Li L8, which is their highly anticipated 5-seat flagship SUV, officially launched on June 23, 2026. And the next-generation Li L6, which comes equipped with a massive 51 kilowatt-hour battery, is launching right now in July 2026.
So the cars are rolling out.
They are. But here's the key difference. While the broader market knows these cars exist, the actual financial impact of these sales is not priced into the stock yet. The market is firmly in show-me mode. They want proof.
Right. They want to see the receipts before they start buying the stock again. They've been burned by the Q1 loss.
Precisely, and that is why the August 2026 fiscal quarter 2 earnings call is the critical make-or-break date to watch.
That's the real test.
That call is the true catalyst. That is when management will issue their FQ3 guidance. That guidance will provide the cold, hard mathematical proof of whether or not the L8 and L6 ramp-up is actually happening as planned. It will prove to Wall Street if Li Auto's execution is matching their ambition.
And outside of their own factory, there are broader macro factors at play too, right?
Ah,
Because they don't operate in a vacuum.
definitely. Looking at the macro environment, global EV sales actually rose 4% year over year in May 2026.
So the EV market isn't dead.
Not at all. Which tells us that despite all the doom and gloom in the media right now, the broader macro adoption curve for electric vehicles is still intact. There are also unconfirmed rumors and patent filings floating around about updated Li 8 and Mega models featuring advanced new LiDAR sensors.
Oh, that's interesting.
Yeah, if those rumors materialize, they could act as highly speculative catalysts. Plus, they recently expanded their sales footprint overseas into Macau.
Macau, that's a unique choice.
It is a very calculated, interesting test of their demand outside the mainland, without taking on the massive risk of fully entering the European or U.S. markets just yet. Catalysts tell us what could change the story. Now let's pivot to the chart.
Okay, so we have the catalysts lined up over the next few months, but I want to bridge the gap between this future potential and the reality of today. How are traders and the broader market physically pricing the stock right now?
It's ugly.
Very ugly. As we mentioned at the top, the stock sits at 11.735 cents, which is drastically down from its $32.03 high. It has officially breached its 5-year trading floor, which historically sat around $17.
A major breakdown.
Yeah, some technical analysts are suggesting this $12 to $13 range might serve as a strong bottoming base. But what I am really looking at is a price-to-sales ratio. It is sitting at just 0.8.
That is incredibly low.
I want to unpack that because for a hypergrowth tech or EV company, a price-to-sales ratio of under 1 is virtually unheard of. Legacy automakers that barely grow trade at those levels. This indicates a deeply, deeply oversold technical state. It looks perfectly ripe for a mean reversion bounce.
On paper, absolutely.
But I have to remain cautious here. We are clearly in a capitulation phase. The psychological pessimism is extreme. Investors are throwing in the towel right and left. Is there any structural support left at all, or is the floor just completely falling out?
Visually, on a standard chart, it looks like an absolute freefall. I won't sugarcoat it. But there is a massive technical and psychological floor hidden just beneath the surface of the panic, and it comes down to extreme insider alignment.
Okay, what do you mean by that?
On June 16, 2026, senior executives at Li Auto were granted a massive equity incentive package. We are talking HK $2.3 billion.
Wait, how much is that in US dollars?
That translates to roughly $293.6 million US dollars.
That is an astonishing amount of money to hand out to executives during a transition trough where you're losing money.
It is. But here is the kicker, and this changes everything. Those incentives only vest if the executive team achieves a HK $1 trillion market cap.
HK $1 trillion, which is what, 127 billion US?
Roughly 127.7 billion US dollars, yeah.
Wow. Okay, let me just put this in perspective for you listening.
Huh?
That is like a ship's captain locking themselves in the wheelhouse during a Category 5 hurricane. They have literally tied hundreds of millions of dollars of their own personal wealth to a 10x recovery in the company's valuation.
Exactly.
They either steer the ship out of the storm and hit that $1 trillion mark, or they go down with the ship and get absolutely nothing.
Nothing. Think about the massive internal operational drive that creates for reversal. When you are looking at extreme oversold levels on a chart, finding that kind of internal psychological floor is huge. It tells you that the people steering the ship are intensely personally motivated to fix the stock price.
It's skin in the game on steroids.
Exactly. And naturally, traders who are looking to map these deeply oversold levels or trying to identify where these historical floors might hold often look for clean chart workflows to manage that volatility.
So the chart gives us price structure, but what does market sentiment look like?
Well, it's divided.
Because there's a glaring contradiction staring us in the face here. The financial media and retail sentiment are screaming bearish right now. Everyone on retail forums is panicking over the 15% June delivery drop.
Which we discussed.
Right. Yet, as you just pointed out, the insiders, the people who actually know what is happening on the factory floor, are essentially betting their massive $293 million bonuses on a 10x long-term recovery. How do we reconcile that massive disconnect?
It is the classic disconnect between short-term noise and long-term vision. The overall market mood right now is undeniably bearish to neutral.
Yeah, you can feel the fear.
That short-term delivery softness has spooked retail investors. Yeah. And there's a broader sector-wide rotation happening across the market. Institutional investors are rotating away from pure-play, hyper-growth EV stocks entirely.
Where are they going?
They're fleeing toward the perceived safety of traditional value names. Think GM and Ford. They want dividends and slower, steady transitions. So the broader market is obsessing over one single month of delivery slumps, completely discounting both the insider conviction and the massive revenue potential of the upcoming L-series ramp.
But if the retail market is panicking, the contrarians must be starting to circle, right? Because they love this kind of setup.
They absolutely are.
Yeah.
We are starting to see contrarian buy signals flashing across financial platforms. For example, Seeking Alpha recently took a very bullish stance on Auto, explicitly calling it a great buy for the contrarian investor.
Oh, really?
Yeah, they specifically pointed to this exact $12 and $13 range as a prime bottoming opportunity. So what you have is institutional and insider confidence quietly building a concrete foundation while the retail sentiment is still caught up in the emotional capitulation phase. That sentiment picture is useful, but we still need to talk about the risks.
We absolutely do. Because before anyone listening gets swept up in this contrarian upside and the allure of those massive insider incentives, we have a responsibility to look at what could actually make this company fail. We have to look at the bear case.
Because it's very real.
It is. The reality on the ground is that the China new energy vehicle market is absolutely brutal right now. It is an all-out, margin-crushing price war. Aggressive discounting is the norm just to keep cars moving off the lot.
It's a race to the bottom for pricing.
And their peers, companies like NIO and XPeng, are not sitting still. They are posting strong growth right now and actively stealing market share during Li Auto's transition law.
That is the most immediate and dangerous threat. When you are caught in the middle of a product transition, you're inherently vulnerable. You can't sell cars you aren't producing yet, and the competitors are ruthlessly taking advantage of that gap in the market.
And there is a specific metric here that we need to lean into, and that is the Altman Z-score.
Yeah.
It currently sits at 1.77. For you following along who might not live in financial modeling spreadsheets, the Altman Z-score is a formula used by analysts to predict the probability that a firm will go into bankruptcy within 2 years.
It's a very standard stress test.
Right. It weighs things like working capital and retained earnings. A score of 1.77 puts Li Auto firmly in the gray zone. It suggests a very real possibility of financial distress if this product transition drags on longer than expected.
The clock is ticking.
Combine that Z-score with a low profitability rank of just 4 out of 10 right now, and the aggressive cash burn from building out those 4,000 superchargers, we have to state this plainly. If the new L8 and L6 models flop, this transition trough could become a permanent grave.
It is a very real possibility, and we have to acknowledge those downside risks honestly without fear-mongering. Execution failure is the ultimate bear case here. If the new cars roll off the line and consumers simply don't buy them, the entire thesis breaks apart.
The trillion-dollar dream dies.
It does. But to maintain a balanced analytical perspective, we also have to recognize what the market has already done. The 60% drop in the stock price has already priced in a massive amount of this current margin compression and delivery weakness.
So the bad news is already in the price.
Largely, yes.
Yeah.
The market has already violently punished them for the reality of today. The actual risk now is whether they fail to deliver on the future reality. Yes, the Z-score is in the gray zone, but that rich balance sheet we discussed earlier acts as a massive buffer against that distress.
It buys them time.
Exactly. It allows them to absorb the blows of this price war, but that buffer won't last forever if the execution ultimately fails.
So with everything on the table, what's the final verdict?
It comes down to weighing the catalysts against the survival risk.
Right. We are weighing the very real existential threat of a brutal, localized EV price war and potential financial distress
Against a dominant market moat, a 29.6% year-to-date delivery growth rate, and some of the most extreme, aggressive insider incentives I've ever seen.
So what's the final score?
Based on weighing all of those conflicting factors, the final bullish score comes out to a 7 out of 10. The final stance is speculative bullish.
Speculative being the key word there.
Absolutely. You are looking at exceptionally high contrarian upside, but it comes firmly attached to near-term execution risk.
And how should an investor approach that timeline?
Well, it completely depends on your personal strategy. For long-term investors, this is a multi-year hold, banking entirely on that 2027 recovery thesis playing out.
Enduring the renovation, as we said.
Right. But for a shorter-term approach, it could be viewed as a swing trade, playing the high volatility leading into that crucial August FQ2 earnings call, where a shift in guidance could radically change the narrative. Ultimately, the company's being priced right now as if it is going to fail, yet it maintains an absolute stranglehold on the full-size premium SUV mode.
And we want to clearly remind you that this discussion is an educational breakdown, not financial advice. We aren't telling you to buy, sell, or hold this stock, but we do want to leave you with a final provocative thought to mull over as you do your own research.
What's the thought?
When you step back and look at the sheer scale of the macroeconomic forces at play here, you have to ask yourself, can the immense gravity of a $1 trillion market cap incentive, which is pushing leadership to do absolutely everything in their power to succeed,
Which is a massive force.
right, can that actually overpower the brutal, margin-crushing reality of a localized Chinese EV price war? Which of those two unstoppable forces ultimately wins out?
That is the trillion-dollar question.
Literally. And if you want a cleaner way to read trading charts, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts easier to stand, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.